All right. So today we're going to talk a little bit about life insurance. So life insurance can be a super complex issue, or it can be just very, very simple. The the problem is that if it's becoming a complex situation, if you could just pass this around, you probably have the wrong product. You know what I'm going to advocate, and we're going to talk about all the different products that are available, but it's going to come down to just kind of background information, because I think I'll try and sell you, and I think most people who have your best interest at heart will try and sell you on the fact that you don't need to be sold anything. You just need to go out and get term life insurance and call it done. And if you're mixing, there's other products out there that mix investments and life insurance together, and you end up with a more complex product. You end up with kind of a mediocre at best investment, and you also end up with a product that typically needs to be explained to you by a salesperson who is going to charge you a commission. And so the value of all this, it just makes it whatever. I hope you come to the conclusion that you need just term life insurance. So what we're going to talk about, we're going to define the purpose, define your life insurance needs, distinguish between the different types, provisions of contracts, create a plan, and the rest of that. And then annuities. Annuities are a good deal. Life insurance, you got to die to collect it. That's not a very optimistic venture. But annuities are kind of just the opposite. The longer you live, you keep collecting. So you establish an annuity, and until you die, it keeps paying you. So it's a little bit more on the optimistic side. Whether it becomes part of your investment portfolio, that's up to you. But at least in concept, it's kind of cool in that way. So what is life insurance? Life insurance is a risk mitigation technique. It is, there's lots of bad things that can happen. We're all human. We all can die at some point, but the degree of that, disruption on the rest of the people around you, the rest of the people count on you, depends on how well prepared you are. So if it's already going to be a fairly traumatic event, somebody passing away, but it doesn't need to be a financial game changer, game stopper, because you didn't have any insurance. So your needs for insurance, though, are going to vary as you go through life. But anyway, life insurance, purchase a policy. They pay a lump sum at some time of the policyholder's death, and sometimes when they're still alive in certain occasions. But why do you need it? And this gets to how much you need in terms of insurance. If you've got a family and you're the sole breadwinner or the primary, you bought this home with two incomes, and now all of a sudden one income's gone, they got to sell the home, they've got to do whatever. That shouldn't be that way. It could be worst case where you've got kids and both parents are killed, and now in addition to trying to take care of the kids, the person who ends up in that position is also financially strapped because you didn't take care of that as well. So paying off a home mortgage and giving people a place to live is important. Part of your estate, that's kind of creepy. I mean, nobody really wants to win the lottery, because somebody died, and it's not. That doesn't really, calculate into the life insurance equation that we're going to talk about in terms of the life insurance you need is going to be based upon basically your liabilities that you would be leaving people with. Save money for retirement or income and education for children. Those are, noble goals, but I would argue that life insurance is not the vehicle for that. That gets into these hybrid life insurance scams. I wouldn't say scams, that's kind of a strong word, but life insurance structures where you're investing and there's investment people out there that specialize in that and do quite well, and it's a very straightforward proposition. And then there's life insurance people who offer term life insurance, and that's pretty straightforward as well. But when you blend the two And you can just tell by the names, whole life, universal life, variable life. I mean, what does that mean? I mean, it's more sales techniques than it is something tangible. Term I can understand. Term means I need so much insurance, I need $1 million, and I'm going to pay on that for 20 years. At the end of that 20 years, it's done. There is no cash value. I no longer have insurance. But guess what? I don't need insurance at that point because all those liabilities, all those debts that I was trying to insure are taken care of. The house is paid off. The kids are in school. Or the kids are, say, 17, 18 years old. So in terms of supporting them, you're within sight of the finish line. You get them through college and then, they're good to go. So anyway, the amount of insurance you have should decrease over time, which is good because insurance also gets more expensive. There's people, again, not the best job or something I'd want to do, but actuaries, they develop actuarial tables, and they'll look at you up, they'll size you up, and probably pretty shortly they'll also be looking at your DNA and other stuff and decide what your propensity is for dying. When. And there's people who can with pretty certainty, especially when they use a broad enough sample, have some pretty good accuracy across their pool of all the people insured in terms of how many people are going to die at a given time and given thing. And there's also lifestyle stuff. If you're smoke, that's going to influence things. If you drink, that could also influence your health, but also put you in drunk driving type situations and other thing. And obviously marijuana, all that stuff. Everything's going to be a part of it. They want to know as much information as possible because they want to know what kind of risk they're exposing themselves to. Other things, medical expenses, funeral costs, so some of those end-of-life things. Again, just a minimal amount to get you buried and take the focus of that time in their life away from financial issues and more on dealing with somebody checking out. So principal life insurance, mortality tables, so actuarial tables, whatever you want to call them, but when people are gonna die. Women tend to live a little longer. You get places like Russia where women live way longer, and men still life expectancy in Russia is quite young. In the 50s for men. A lot of alcohol, a lot of other things going on. And in China, it's kind of the opposite. Where you have more males due to the government policy. So I don't know. Those folks could get together and anyway, off the subject. Excess females and excess males. How long will you live? So premiums based upon your life expectancy. So like I say, it's going to get real expensive as you get older. But again, you should not need it when you get older. And so you want to be essentially self-insured. I mean, what are they going to do? You're going to have a $1 million life insurance policy? I would rather have $1 million in the bank, that a nest egg where essentially now I'm self-insured. Whatever debts I've got, I can cover them. Whatever other problems, for the family and stuff, they're in much better shape. And, oh, by the way, because I put money in investments rather than, life insurance policy type investments, the true pure investments will typically do far, far better. So do I need life insurance? Just looking across the class, I don't know everybody's history, but if you're a single person, no kids, no responsibilities, you can even own a house. Who cares? Let the bank take it. I mean, it's not whatever. You don't have people necessarily relying on you. Others of you may have, kids. You may have already purchased a house, and if you, although you think, okay, I can't quite afford life insurance right now, you would really be leaving some people in a world of hurt if you were to pass away, car wreck or strange illness or something quickly. But you don't have to feel guilty about it. All you have to do is just get some life insurance. And term life insurance for somebody in their 20s and 30s, I mean, we're talking like $1 million policy for not much, There was a point, I mean, my past, I flew, and I flew a lot of combat missions and stuff like that. And so there was one particular time where I had like 3 different policies, couple $1 million worth of coverage just to cover everything. And I, after that, but I think that was a Kosovo thing where we were going into a situation. Anyway, term life insurance, beautiful thing. I established those policies. After I was back and nothing bad happened, I canceled them. But you can do that. Most people aren't in that sort of lifestyle and probably don't need to do that. But you know, I had 2 kids and you know, a lot of things going on, and it would just soften the blow. And all told, it was certainly less than $100 a month for all that insurance. And for what we could look at some of the rates, but again, $1 million, you know, we're talking in the 30, 20, you know, 20, 30, 40, $50, depending on what you're going to get. And this is just strict term life insurance. There's no cash value to it at the end. When you're, you know, if you quit paying on the policy, it just goes away. Yes?
What's the standard term?
Standard term, well, it depends on how you do it, but most people would want to go like with a 20-year type thing, 20-year renewable, you know. That's what I would do, because that way, you know, you don't get obviously canceled on, and typically there's a contract in there where the rates won't change for the period of that contract. Now, when you go to renew again when you're in your 40s, yeah, you're going to be paying a little bit more. But again, you should need a little bit less insurance, so maybe your payments will stay about the same. Yeah, so it you know, this bit about your situation, you know, financially, do you have children? Do you have a basically a stay-at-home spouse or partner or whatever you like to call it, somebody who would be adversely affected by you know, checking out, that will work. How much money do you want to leave to your dependents? Again, it's not the calculation isn't like that they're getting gambling ones. The calculation is, okay, they need to go to college for a while. They you know, need this. We'd like to pay off the house first. There's an expectation in most life insurance calculations that the non-working spouse at some point is probably going to go back to work. You know, they're not going to live a life of leisure for forever. I mean, if they're the stay-at-home, and most people who are even stay-at-home spouses, parents, you know, after the kids are in school, just out of boredom, they typically go back to work. So it doesn't have to be forever, but you'd want to do a calculation. When you want to retire, what income do you think you'll need? You know, if you are, you know, planning on working 30 years, putting money aside, you know, maybe having a cabin, maybe having some sort of pension plan that you're going to retire to, that is a realistic thing to have in your calculation. The fact that if you die in your 20s or 30s, you're not going to have a retirement, you're not going to have a pension, so you may have to have some money in there to, again, prevent people having to work, you know, into their dying days just because they don't have any money set aside. So that might warrant, you know, an extra chunk of money that you would go for in that calculation. And how much will you be able to pay? Again, you know, I would do the calculation, how much do I need, get the term life insurance, and I think you'll find that it's not that expensive, and your ability to pay, that definitely becomes a factor if you go with, you know, whole life, variable life, one of these investment type things. The situation too is not to, oh man, I got insurance for, you know, $20 a month, I'm set, and now I don't have to save any money. No, the expectation is, since you went with the term life and you're keeping your life insurance and your investments separate, is that, you know, that whatever, extra couple of $100 a month, rather than you didn't use some complex life insurance policy, you put that other money into a true investment, and you start building that nest egg. That is going to alleviate that need to have life insurance into your old age. I mean, it's not just because you save a little money. Most of these calculations, when they say you should avoid those complex life insurance policies, are predicated on the fact that you're not just going to go blow all that savings. You're going to do something with that money. We'll look at a couple videos. They've got some factors in here which, again, I'm not necessarily in line with these guys because there's too many variables that these things don't necessarily calculate. You know, the easy method, 70% of your salary for 7 years while your family adjusts. So if you do that, let's say you're making, well, let's be maybe optimistic, maybe realistic. I don't know, but we'll go with 100,000 just for ease of simplicity. So, 70% of your salary for 7 years while your family adjusts. So, 700,000 times 70 is going to be what? Just short of $500,000. You could get a $500,000 policy for a reasonable amount. But how many kids do you have? How big a house do you have? None of those things went into that formula. So easy, maybe oversimplified in my mind. Dual income, no kids, half the debts and the funeral expenses. Yeah, I mean, that's not a whole lot. You know, we got a $300,000 house, and funeral expenses, let's say, are 10 grand. I don't know. I mean, you can do what you want, but I'd rather, you know, get a little casket and put the rest of the money on the bar. But that's just me. But anyway, depends what you want to do. But no kids, and you know, your spouse, partner they can certainly go back to work, and they'll work through this. It's mainly an emotional loss because there's not that many folks relying on you, and they're already in the workforce. Non-working spouse, multiply the number of years till the youngest child reaches 18 by 10,000. So, again, how many children do you have? It doesn't say that. If I got one child or 6 children, again, I'm just saying these formulas sometimes are a little too low. Now, family need method, more thorough than the first 3 because it also includes employer-provided insurance, Social Security benefits, income, and assets. And I would also think the number of children you have. But anyway, this is more of a needs-based thing because this is not a tough equation. You know, okay, I own, I still owe, just bought the house. Let's say I owe $300,000 on the house. Okay, I need, money for the kids' college. Let's say, I don't know, if I'm giving that money today, probably what, $50,000-$100,000 per kid. Will, if it's invested, that will generate enough money for college. I don't know. I'm just pulling these numbers. You may have different expectations. State schools, out of state, Ivy League. It's all different. Anyway, you come up with some calculation. You can do make your calculation, and then you say, okay, since this other person's not going to be working, not going to be contributing to retirement, ultimately, maybe $250,000, $500,000 lump sum now. If invested smartly over the next 20 years, will generate a pretty big nest egg. So our retirement needs are taken care of. Anyway, you can do the math and come up with $750, $100, or $1 million, or whatever you need in your policy. And that's more, that will minimize, this whole focus on financial bit when somebody passes away, and that's the goal of life insurance. It's to minimize the disruption. I mean, it's a tough break that you can't be there for the rest of all these people's lives, but you can take easy steps to make it financially not a factor. So you can see when you're thinking about it, kind of logically and this way. Is anybody? I mean, am I losing anybody on the logic here? So if you agree with me in terms of this logic, you can see why I think it's to the point of disgusting to have like these Gerber baby life insurance policies. That's really creepy because number one, the child needs to die for you to get the money, and then the parents were the ones who needed the insurance. I mean, that baby is going to be adversely affected if the parents die, but the baby itself, I mean. And the last thing you want to do is bury your child and then collect a check. I mean, what extra expenses do you have because that baby died? That's just wrong. I mean, obviously they can give you the insurance for super cheap because the baby's brand new. Basically, it's gonna it's gonna go for a long time once it's past that infant mortality stage. But if it's to the point where you're getting life insurance for this baby, it is a safe bet that little kid is good to go. So, that's why, you can tell that there's a lot of misinformation in the insurance world because you see those commercials all the time where they've got a little picture of the baby and they're talking about getting life insurance for the baby. That's completely wrong-headed. Get insurance for the parents. That's who needs the insurance. Yes?
I actually thought when I saw those commercials it was actually vice versa. Like if the baby passes on, or no, if parents pass on, the baby gets the insurance.
I hope
Like,
so.
That's how
it should be.
yeah, that's how the commercials always sound.
Yeah, yeah.
It's like they're saying like, how are we going to pay for college?
Maybe I'm just slandering the Gerber people, but I'll do some research. But
I want to sell you both.
yeah, well that would but I'm telling you, the little baby does not need insurance. I mean, if you got medical insurance for that little baby, that'll do some good. You know, the baby develops, let's say, leukemia or something. I mean, golly, that's going to be expensive, and that would be helpful. But life insurance for an infant, that's anyway. Two types of life insurance companies. This is a don't worry too much about it because I don't care really how the company's organized. You know, the authors talk about, stock life insurance companies and mutual life insurance companies. One's member owned and one's owned by stockholders. You know, it doesn't really matter. But that's, you will hear those names. You'll hear, Mutual of Omaha, and you'll hear, New York Life or whatever. And anyway, they're different company structures, but for you as the insured, as the customer, I don't really care.
But, this one pays a policy dividend, does the other one pay a policy?
Yeah, but again, this whole dividend and this non-participating, they're assuming you haven't gone with term life insurance. I'm saying keep it dead easy. I don't want an investment. I want just term life insurance. Term life insurance, I pay, let's say $40 a month for 20 years of coverage at $1 million, or $20 a month for 20 years, and that's going to give me $1 million for the coverage, and there's absolutely no cash value. There's nothing at the end. I can't take a loan on this insurance policy. I can't do anything. Zero cash value. What they're talking about here are these investment type things where they're a blended policy. In fact, before we go much further, let me see if I thought I had that in here. Yeah, I guess it didn't save. Apologize for a second when I go back to YouTube to I put them on the put the URLs on the slides. I think it was term versus whole life. Can't remember the search parameters I used. Oh, I know where to get it. I can get off the other one. Oh. Now, see, the insurance companies, you can see that they're going to come, they're going to want to argue that you may want something different. And
So that's called whole life when it's an investment?
well, we'll talk more about that. There's all these different concepts because they kind of get a bad name, and so then they change the name. There's whole, variable. It's kind of a moving target. There was a Forbes one that I wanted to show. Let me see if I can find that one first off for you. Yeah. Sue Zorman she just gets kind of over the top on the whole thing. Yeah, Dave Ramsey's too long. Let me take it back just one slide. You saw those URLs on there, right? That was just a second ago. Perm versus permanent is what they're calling it. We're going to switch to the other format here in just a second. Just because they converted it for us. Anyway, let's pause it for just a sec, let the buffer build. There's different opinions. You can look on this on YouTube, whoever you like. Generally, if it's sponsored by one of the insurance companies, they're going to be pretty big proponents of some of the more complex life insurance policies. If there's somebody who doesn't have a dog in the fight, if there's some sort of financial, Dave Ramsey, Sue Zorman, some guy with Forbes like this, it's going to be a different approach. So, again, let's listen to this guy. So CFP is a certified financial planner. That's a designation a lot of times that you'll look for with somebody who's...
Hi, this is Tim Maurer with 90 Second Finance. Today I'm going to answer a question that I get all the time, and that is, should I be buying term life insurance or permanent life insurance? And I should say that there are appropriate uses for both of these, but I will say I do believe that permanent life insurance is oversold. So here's why. Term life insurance is just a pure insurance calculation with actuaries at the insurance company that you are going to live or die within a period of time that's normally ranging between 5 and 30 years. Permanent life insurance also has that pure insurance at its core, and then it also has a savings vehicle. But this savings vehicle comes at a cost. And the cost is so substantial that it is important that you have met other financial planning needs before you spend a dime on permanent life insurance. That is, you should have adequate emergency reserves between 3 and 12 months of your living expenses. You should have maxed out 401ks. That's $17,500 in 2013.
So you understand, we'll let the buffer build just a sec. You understand what he's saying, that a pure insurance is essentially what term would be. You're just paying for insurance. You're not paying for any investment vehicle. He's talking about if you're going to be involved in permanent insurance that includes sort of a savings vehicle, well, that's great. You should be lauded for saving your money and doing all that. But, before you put it into a complex retirement investment savings vehicle, you should make sure that your other investment type things are met. An emergency fund, obviously a little bit of cash to keep you from jumping into debt and ringing up your credit cards the first time your car breaks or something like that. A 401k is a tax deferred investment that's going to be favorable to you come tax time, and again, an insurance product would not offer that. Roth IRA, similar, within the limits. You'll probably make it to hopefully a certain income where you're no longer available for some of the IRA products, but it works in a similar method. Roth, actually, they tax you up front, but then the taxes are not paid in retirement. And then education. A lot of times there's if your primary investment goal is to save for your children's education, a lot of times there's state-sponsored programs that are somewhat subsidized that, again, are probably better value for what you're trying to do. So let's let them run again.
For each spouse. Maxed out your Roth IRAs. That's another $5,000 for each person. And you should also have adequately funded your education. Now, here's one of the things I hear insurance agents say that want to sell permanent life insurance. They say to people, look, term life insurance only pays out in 2% of cases. You know what I say to that? That's great news, because that means you haven't died. This is Tim Maurer with 90 Second Finance.
So we'll look at another video next week. What's that? Tim Maurer, wasn't it?
Tim Bauer.
Wow.
M-A-U.
Yeah, we'll go right back to here. I don't want to.
I can't read that.
Okay. Where are you seeing it? I can help you out if I can see it.
Yeah, I think it shows it. M-A-U-R-E.
Whoops. And then it's after the races. A lot of scrolling on here. Anyway, yeah, you'll find, a whole bunch of information out there regarding different types of insurance on the internet. But I think what I just said is going to hold true. If it's sponsored by an insurance company, they'll be pretty open-minded about why you should have some of these more complex products. If it's somebody who's just giving advice from a financial perspective, they'll tell you to largely keep your insurance and your investments separate, because again, they're different products. So anyway, let's look at the different products. So the term one, and the reason it's first is because it's easiest to explain. Protection for a specified period of time. If you stop paying premiums, coverage stops. Renewability. You can renew the policy without having a physical at the end of the term. That's typically, which is a good thing. I when I boosted up my insurance, I actually had I guess technically she'd be a phlebotomist, but she wore like kind of a nurse uniform to make it look more official. But she came over to our house actually and drew blood for me, because they I'm now kind of a risk to them, and they want to make sure that I'm, they're concerned when they see somebody plussing up insurance all at once. I may or may not have mentioned that I was going off to fly fighters in the war, but anyway, she was looking for cholesterol levels and things like that, other indicators. So, but anyway, it's dead simple. You can go online, you could get a quote today, and you could buy it online if you want. And a lot of times, not even require a physical. If they say no physical required, sometimes you may want to stay away from that, because again, you want to be in the most selective pool. If they require a physical out of people and their rates are better, that might be something you want to get, because it might exclude some of these people. They might do a blood test, and people say they're not smoking, but yet traces show up, and I don't know what they're going to test for. But anyway, I want to be in the lowest risk pool if that's where I'm at. If I got issues, then I want to go for one of those no physical required. If I'm somebody who's borderline diabetic or already has some issues. And anyway, a little strategy on that. But term life insurance is as easy as it sounds. Multi-year level term, most popular form. So, there's different ways you can do this. As you get older, theoretically, your policy amount would go up, right? Because your expectation is you could die a little bit quicker. Or you could also make this and say, okay, it's going to be $20 every month for the next 20 years, but the amount you get awarded, today you get $1 million. By the end of the policy, you're only getting $500,000. So again, you can vary things to even it out, or you can just go with a level term, level whatever, and the assumption is going to be you're going to be paying a little bit more at first, represented to your coverage, and at the end you're going to be getting a good deal. But again, when you quit paying your term life, and I have this happen all the time, where you change of address, change of whatever, and they send you a few letters saying, look, dude, if you don't, start paying this policy again, we're going to terminate it. And if you want to get back in after it's terminated, we could, it's a new deal. It could be higher fees, could subject you to a physical and the rest of that. Conversion option, again, I'm not interested in that because I don't want to go to a whole life policy. Decreasing term, so premium stays the same, but amount of coverage decreases. And like I said, there's different ways they could do that. Return on premium, policy refunds every amount if outlives the predefined term. Typically not part of the policy. That would make for a more expensive policy, and I'm not interested in that. I want the maximum amount of coverage for the least amount of money, because insurance is a necessity. I want to have more money available for traditional investments, and I only want to pay for insurance the minimum amount possible to make sure I'm protected. Now, whole life insurance, and again, also called straight life. So every time, I mean, anyway, I'd just be suspicious of the kind of ambiguous names. I think those kind of give you an indication of what's going on. You pay the premium as long as you live. The amount of premium depends on your age. Provides a death benefit and accumulates a cash value, so there's an investment portion in it. You can borrow against it, but that last note, look carefully at the rate of return on your money that your money earns, because a lot of times it's not what you would want. There's another video. I'm not going to deal with the buffering issues, and I'll bring in the other computer next week, but I'll show you another one where, you know, kind of the call-in show where people call in and they talk about how much money they've invested, for how long of time they've invested it, and the ladies just, you know, just kind of whatever, just gets on them for, do you realize how much money you would actually have if you had put that in a real investment rather than this insurance policy? Because a lot of times these insurance policies, you know, we discuss the time value of money quite a bit, right? Well, what's painful on when you're paying a commission is, if you're the salesman for an insurance policy, you get your commission up front, which is the worst possible time to take it out, you know, because that's the time value of money. So you come up with this, you know, big chunk of money up front, and that's where the commission is taken from. And so it just means that they don't, you know, generate, start to increase in value very quickly, because that initial seed money has been decreased by the salesman's commission coming out of that upfront money, or the first couple of years of the money. So anyway, the rate of return is not going to be comparable with traditional investments. Limited payment policies. So sometimes you can actually, you know, pay up a life insurance policy if it's the investment type. The understanding that the dividends or whatever will be paying that policy. But anyway, I'm not going there. Variable life. So the reason why they come up with different policies is to make them maybe more attractive, especially when the stock market is roaring and people feel like, why do I have money in this policy? And so they come with a variable that, you know, invests in the stock market and things like that. Yes?
So if I'm looking at this right, I understand limited payment policy, you're paid up and you remain insured for life. Basically, this policy is going to pay out at some point. You're going to die and it's going to pay out.
Oh, yeah.
100% of their policies are going to pay
out.
Yeah. Which means they're not going to pay you very much, are they? If they know they have
Well,
to pay
no,
out.
it means that you pay them a lot.
Where do they make their money at?
Oh, yeah, they're maybe I'll find these other videos, but these people are paying like $600-800 a month for life insurance. You know, or if it's limited payment till they're paid up. But again, that is a huge chunk of change. You know, for what should be, you know, if I can get the protection I need, let's say for $40, $20, whatever. We'll look at some actual numbers again next week when we've got a better internet cooperation here. But I'll show you some of the examples. But yeah, it's not like they're even close in terms of the dollar amount being put forward. But they argue to young families. They say, hey, you know, this is a good thing for you, and it's going to force you to save. And it's, I mean, the people that are buying the policies, their hearts are in the right place. They're doing the right thing. They're trying to save money, but you know, it shouldn't require a salesman to do it. And the vehicle that they're choosing, the life insurance policy, the complex one, is usually not the vehicle that is serving their needs the best. So yeah, that upper bullet, that limited payment policy is just a feature of some of the policies. Variable life is a whole different type of thing. It's not that much different than whole life or straight life, but what it does try and advertise is that you're participating in the stock and the bond market. So when you feel like, you know, you look at your little silly life insurance policy when the market's raging, they're getting 10% and you're getting 4%, and you're going, wait a minute, this isn't right. Oh no, we've got a new product. This one's a variable one. This one can you know, your death benefit is guaranteed, but the investment part will be more related to the stock market. So maybe it's better, but again, it's more complex than it needs to be. And again, when I buy stocks, Or when I buy mutual funds, I don't use a salesman or a broker. All that stuff can be done directly. If I am going to pay a fee, I'm going to pay it to somebody that I've got a fiduciary relationship with, a financial planner who is only looking after my best interest, does not have a commission riding on this, and is just going to say, this is what you need or this is what I recommend. But anytime there's commissions and sales involved, no, you want to be paying that person by the hour, or, if anything, maybe a percentage of your overall income generated. I'm sure there's some people who work like that. If I make a huge $1 million, you get a little cut at the end. That's fine. But don't take your cut up front, because that is killing me in the time value of money. Adjustable life, so whole life, but you can change your policy as your needs change. Again, trying to bring in some more flexibility. Again, universal life, straight life, variable. It's like, anyway, universal life, more direct control, premiums. You have to read the brochure. You have to read the contract. I mean, these names are a bit ambiguous. But again, it's all based on the premise that you're blending a life insurance product with a investment product, which and because it's a complex product, it's not something you're buying online. It's something that you're buying through a salesman. Group life, now this is a whole different category. So we talked about two main types of insurance we talked about were term life insurance, and then these other products, variable, whole, straight, all those other things. So that's the decision you need to make. Are you going to do just a term life insurance that is just what the guy labeled on his slide as PI, pure insurance, just insurance, and you'll only collect in 2% of the occasions? That's awesome. That means 98% of the time I'm going to outlive the policy, which is a good thing for me. You know what I mean? You can't take it with you. I do not care about having a $1 million life insurance policy if I'm not here. I mean, insurance is for the people that are left behind, not the person dying. And then you had those other complex life insurance policies. With group life insurance, it's not a whole different kind of insurance. It's just typically insurance that you get through your employer. And again, for simplicity's sake, it's usually term. So no physical is required. The reason why that would often be a benefit or a characteristic of group is that they're insuring a huge group. So if there is a person or two sneaking by with some disease that's undetected, it's going to be, they're going to be all right, because the numbers involved are going to make that they're not going to end up with people kind of cherry picking and going to work for a company just so they can get insurance, just so they do this. Anyway, not normally a factor. Other things, endowment life insurance. So, coverage from the beginning of a contract and guarantees payment of a specified sum to the insured. Credit life insurance. Credit life insurance is depends how it's offered, and what they talk about expensive protection, but many times it's not an option, and it's not necessarily that expensive. But if I'm a mortgage broker, or if I'm somebody selling you a car, do I want to get in there and fight with a grieving widow over making sure that this car gets paid off and the rest of that? Now, usually as part of the contract, part of the loan contract, there'll be something in there buried where essentially you're signing up for a small life insurance policy with them, the creditor, listed as the beneficiary. So if you've got policies like that, though, you need to know about it, because this whole calculation of, okay, I've got this mortgage outstanding, I need to make sure I got coverage for it. Well, the bank may have already insisted on that. The bank, in the loan documents, you may have signed a thing basically saying that in the event of your death, the bank has paid off for the house, and so you own it free and clear, which is a good thing for you. But it's also a very good thing for the bank, because now they don't have to go, worrying about how they're going to get their money back, trying to sue, estates and dead people and stuff like that. It's more straightforward. So, but these other little small insurance policies that you'd want to get independently, like say to pay off your credit card. If it's from the credit card company, it may be, a big group policy may be part of it. But if it pays off you or your spouse directly, it's probably not necessary because, again, it generates some overhead just in the maintaining all these small policies. If you had $1 million policy that was just a larger comprehensive, it would give the person lump sum cash and they could take care of all the debts in your estate and take care of it. Life insurance contracts. So, yep, beneficiaries, obviously who you want in there. The grace period, especially if you're somebody who moves around a little bit and, credit cards being what they are. I think literally my credit card just got canceled again. Another fraud issue. So I think I'm up to like 6 Alaska Airlines Visa card for this. Every time they do that, all my automatic payments go away. And so I need to reestablish them. So anyway, there's always a lag in that. And you want to make sure that when you're doing something like that, that they don't cancel your policy. So typically 60 days, something like that is in there. Reinstatement of lapsed policy has not been turned in for cash. So obviously that's not a factor with the term policy. Non-forfeiture, again, that has to deal with the other policy. Incontestability clause, once you've been in it for 2 years, let's say you're hiding whatever, your diabetic condition or the fact that you, smoke several packs a day, the insurer cannot come back to you and say, hey, we're not paying because you didn't tell us about this. After 2 years, they're saying that the company can't dispute the validity for any reason. Suicide clause during the first 2 years, that is somebody with deep financial trouble. You don't want to incentivize people to go off and kill themselves so that they can get insurance money for their families. That's not a societal good, nor does the insurance company want to pay for that sort of thing. So, yeah, a lot of times they will have a suicide in there. There's also other things like it's not very much more money because it doesn't happen that often, but accidental death and dismemberment is normally you'll see that on group policies where it pays like 2.5 times the amount, or double indemnity, the old Alfred Hitchcock movie. That's about paying off twice as much when you're killed in in an accident rather than a natural death, and some of those things. Sometimes that's a part of policies, but you'll know it when you see it. Automatic premiums. Yeah. And if you've got an investment type policy, they could start drawing out of your cash value of that account to pay for it. Misstatement of age provision. If these are actuarial tables. If you're 50 and you say you're 38, obviously they're going to come after you. That's not an innocent mistake. Can you borrow against the cash value if it's one of those types? A rider. A lot of times there are legal things that you can put in there if you wanted to. Excluding conditions, altering benefits, An insurance company can do certain things. I can't think of a good cause right now, but, you may be in a certain area where there's whatever type of disease that's present from some cancer agent or something, and the insurance company may balk and may say, anyway, I don't see it very often. Accidental death benefit, so that double indemnity, that's what I'm talking about, where it typically pays twice the face value. So that can lead to some, crime show drama, depending on how people are killed. Waiver of premium, disability benefit, and that could be a part of it. And guaranteed insurability option. Sometimes, people, this happens more in medical insurance, where people have existing conditions or developed conditions and also find that they can't get insurance anymore. So, all these different things will be things that you'll look at. But again, insurance can be very, very complex if you let it and make it. But I think it's unnecessarily so. If you go with term life insurance policy and a policy that you can understand, and just reassess your financial position once in a while, and decide how much insurance you need. And the other thing about this too is make sure that these documents are someplace where somebody can get to them, the beneficiary. You know, the insurance company is probably not going to come knocking on the door, you know, to say they owe you a whole bunch of money. In actuality, they probably won't even know. You need somebody to know that the policies exist and to go to the insurance company and seek payment. Other provisions, cost of living protection. So, you know, $1 million may sound like a huge policy right now, but may not be a whole lot of money in, you know, 20 years from now, or less money. Accelerated benefits. Sometimes you end up with people who, you know, have this huge policy, and it's really a you know, troubling time. The person's may have to go into hospice or whatever to cut back on expenses, or may just want to go to hospice. I'm not trying to badmouth hospice, but anyway, again, to try and take that financial pressure off of the end of life. You know, this person is done. You know, they've got weeks, months left. Can we maybe get a little bit of that payment up front while they're still alive to take care of some of these expenses? Second to die option, called survivorships. Sometimes, you know, they don't pay until, well, there can be structured different ways, but survivorship is one person out living the other. Who to buy from? So, yeah, AM Best is kind of like, you know, Standard & Poor's is out there, but AM Best does insurance. Friends, colleagues, maybe, but sometimes bad advice tends to flow. You know, you've got access to so much on the internet that is, I mean, you have to be careful, obviously, but AM Best will tell you about the financial health of the insurance company, and Standard & Poor's will do that as well. But you can usually find a kind of a quoting service. You know, I think I even used one of them, like SelectQuote or somebody before, and it will tell you kind of what's available, what's out there. And then when you actually do go to get involved with a company, it should be a company that you probably have heard of before in some case. I have one through a bank that I deal with that is known to have insurance. The other one was through GE Capital, which is, you know, fairly substantial. General Electric's not going anywhere. So anyway, they're all competitive rates. It's just you don't want to go with, like I say, somebody you probably haven't heard of, or maybe you're just not in the business. So you would look at AM Best and see how they're rated compared to their peers. Choosing your agent. So I don't have one. I mean, that's the simple fact, because I don't need that sort of information. I would not necessarily feel that you got to seek one out. Maybe somebody, you know, maybe you have life insurance or auto insurance with somebody, State Farm or somebody, you've got an agent. That might be a way to go, but I would just be careful that they don't want to steer you into one of the products that is commission-based. If I'm going to be looking for somebody to help me out in financial business, the same person who does my financial planning, if it's not me, would be the same person to you know, give me advice in terms of insurance. But I think you can do some of this yourself, or at least come up with a game plan and then perhaps have it reviewed by somebody. But I guarantee you, if you get it reviewed by an insurance agent, you may often find yourself steered into a policy that anyway, not everybody's bad, but you may get pressured into something that you don't need. We'll spend more time on that next week. We've got a few more slides in here, and I'm not going to try and race through them because we've got Thursday as well. So we'll just talk about this last slide here. But, you know, this how selective they are and whom they insure. There was at one point I had auto insurance through a company, USAA, and all they insured were officers in the military. And so it was a pretty select group, because in order to be an officer, you have to have a college degree. Also, if you even think about getting a DUI, they will throw you out. So, you look at it in terms of insurance group, the rates were phenomenal because it was a very, very select group of people that they're insured. And the same thing would be true of life insurance. You know, you don't necessarily, when you know, this goes back to any kind of financial situation when they say no credit check. Well, if you've got bad credit, that might be the place you want to go. But if you've got good credit, somebody who doesn't do a credit check is not going to be offering the best rates. You know, you want to, if you've got a good credit score, if you're in a good situation, you want that to be known so that you get a great rate. And the same thing is true in life insurance. If you're in perfect health, you're active, you don't have a super high risk kind of lifestyle, then you want to make that known and you want to get the best rate. There's certainly, you know, things are going to get a little strange here in the next couple of years when you know, they start looking, especially as they get more into DNA, and they're able to look at people's DNA profiles and determine what their propensity is for certain diseases. If they get access to that information, that's going to be a whole other facet of insurance. And whether that's right or not, I would just go there and say it's not right. But anyway, it's probably going to happen. Their cost of doing business, return on investments, mortality rate, policies, features, competition. Again, you know, I look at all these type of things when I'm looking at maybe a mutual fund company or investment company. With the insurance company, it's more of a straightforward proposition. Do they have the assets required? Are they highly rated at AM Best? Are they a company that looks like they're going to endure? And is their policy competitive? And that's kind of the end of it. For these other things, now they're looking at, you know, return on investments and other things. I'm not so worried about that. I want to make sure the company's stable, but I'm not viewing my life insurance as an investment. I'm viewing my life insurance as a tool to take care of, you know, my estate and make sure that, you know, of all the bad things that are going to happen when somebody passes away, that the financial bit is not one of them, that everything will proceed. You know, again, I don't want to be rolling in the money and woohoo, you know, giving them some incentive to off me here. But just the same, I don't want to, you know, leave children without the ability for an education or having the house foreclosed upon and the rest of that. So I think we understand. All right, so that'll be it till Thursday. See you then.